Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
All right, welcome back to the Second Bite Podcast. I am your host, Todd Taskey, today with Dr. Jeremy Weisz, CEO and founder of Rise25. Jeremy, super happy to have you with us.
I'm excited. We're going to talk about kind of the state of the union, what's going on this past year, what you see as the future right now. But I do want to encourage people to go and check out. People love your podcast, Todd, the Second Bite Podcast. You get tens of thousands of views on some of these things. And I don't know what some of the fan favorites are. I know Michael Brown, that one stuck out to me, the title of how the seller gets 90% cash at close.
Yeah.
And the employees get the company 10 years later.
Yeah, it's really true. I thought it was hogwash, but first of all, we got a great deal with them for the people at Man Marketing in Chicago, your hometown. Secondly, they have a large contingency of professional people there, and they were great to work with. They're hard to get into sometimes, which we could certainly help with, but they are terrific. And since you brought them up, the good people at StreetShares is a sponsor of the Second Bite Podcast. So you can go to teamshares.com. They're a really good group. I would encourage you to listen to Michael Brown. His interview was interesting from the buyer's perspective. I think, Jeremy, the reason a lot of people like the podcast is because we talk to people that you would never know are at the level of success that they have accomplished in their life. Particularly from a business perspective. And they're just super open about the expectations, the excitement, the concern, the failure, the surprises of going through a transaction and what worked and what didn't. And it's hard to get that information directly from the source. And I think that's why, it's kind of found the audience that it has.
I mean, who should be listening? I mean, obviously anyone who is an agency owner should be listening because you help people sell their agency, and private equity companies should be listening as well.
Yeah, I mean, private equity guys know what they're doing, right? They do it all the time. They're professional. They're smart. They've got a whole team. The side that does not is the entrepreneur, right? They know how to build a business. They know the struggles. They know where they are. But they don't know transactions. And so I can educate somebody on what a transaction's like. If you want, each episode is probably 35 or 40 minutes, and you can hear from people that have sold their business for tens and tens of millions of dollars. And they'll all tell you, here's what worked, here's what didn't, this is what surprised me. I wish I would have done this differently. It's really a great resource.
Yeah. If I read the titles of your podcast episodes, all of them sound compelling to me. There's another one, how 7-figure license deals paved the way for a dramatic exit. So I just encourage people go to Second Bite Podcast. I think they go secondbitepodcast.com or go to Potomac Business Capital.com, and there's a podcast page that people can check it out.
Yep. And wherever the listener podcast, wherever you listen to it, you can find it there and just search for Second Bite Podcast.
Yeah. So I wanted to start off and talk about, whenever you're listening to this right now in time, things are a bit crazy, right? Maybe when someone listens to this 3 years from now, things will still be crazy because something's going on always, but interest rates have doubled, stock market into a bear territory. We have supply chain issues. Inflation is a 40-year high. And I want to know how it's impacted the deal-making environment.
Yeah. So a couple of things I would say. We are, I believe, exactly in the middle of the year, right? Today is the end of June. So Q3 starts tomorrow. All those things are true, right? We've got, plenty of negative news economically. From a deal-making standpoint, it continues to, it has not slowed yet, is probably the right way to say it. There continues to be interest. At the lower end of the market, there's less impact. And when I say lower end, I mean, let's say $1 million to $5 or $6 million of EBITDA companies. And those fit into larger companies. Those companies are less reactive and they're more well planned out, and that planning does not go quarter by quarter, it goes over multiple years. So when they think of something as significant as adding a company to what they're doing, the variance of quarter by quarter is not a big issue in their decision making.
Yeah. Does it factor in? Do some of them think, well, maybe we can get a better deal in this market?
Yeah, 100%. There are many out there that I think as buyers have been a little bit frustrated about where the market was / is, because it's certainly higher than it has been in a long, long time. I don't think it's going to stay there. I don't know how long it will. I don't know if this is the beginning of it going down or not going down, right? But clearly there's softening there. And one of the things to keep in mind is every transaction, a buyer is going to use debt, is going to leverage a transaction. And that helps get their overall returns, whether it's a strategic that doesn't have all that money on the balance sheet or a private equity group. And so the lender is going to be a little bit more cautious. And so, for example, let's just use a real simple example where it's a $2 million EBITDA business. And somebody, to make it up, has to pay $12 million for that. And so let's say that the owner rolls forward $2 million, so there's $10 million left over. And let's say a bank would typically provide somewhere between 2 and 3 times EBITDA for financing. That means the bank will put in 6. So the buyer, the private equity group, has to put in $4 million. So they can compute the return for them on their $4 million of equity. Well, now they can't do that anymore because the bank's saying, we're not putting up 6, right? If we're not putting up 6 if you're only putting up 4. Where 2 years ago, they would say, listen, we could do more than 6 if you want. Today, they're going to say, we'll put up 4, maybe 5. So for the same deal, now they have to put up $6 million of equity. So it's $6 million of equity, we got to get a bigger return to neutralize that. And the only way we can do that is to pay a lower entrance price, right? So we're not going to pay $12 million. Now we're going to pay 10 or 11. So a 6 multiple becomes a 5 multiple, right? And so we are maybe at the very early days of seeing that. The other thing to keep in mind is, again, with the time horizon that deals occur in, private equity has spent the last 2 years raising a lot of money. That money didn't vanish just because interest rates have gone up and just because the stock market's down and everything else. So they need to put that money to work. And this is a better environment to do it in. You know, as an example, I was reading the other day, PayPal, a large public company, PayPal, their stock is down 60 or 70% year to date, right? Shopify, down 70%. Blue chip stock, the market as a whole is down 20%. 20%, let's say 25%, means that a business that used to trade at 8 times now trades at 6. It's just, this is, the economy goes in cycles. This is not end of the world. This is an economic cycle.
You've closed several transactions this year, so I'd love for you to describe some of those.
Great point. We've been fortunate on that. We have one scheduled for, a week or 2 that'll close. We've got 2 others we're putting under LOI, next week. So deal flow is still there and still pretty strong. But as an example, right, if we look to the award categories here, we did 2 really good transactions earlier in the year. So we helped a company called Demand Drive in Boston. Demand Drive is an outsourced BDR firm. Our client partnered with a really good private equity group called Everlane Capital. Our guys have high 40% equity in that business still. Center for Sales Strategy, CSS, partnered with Gemini Investors. Gemini's on their 5th or 6th fund. Gemini's a great private equity group. Matt Sunshine, the CEO, now has a team with a deep checkbook to support him as he begins now to grow that business. Matt owns a very large minority of that business. So these are, for example, two companies that if valuations slip a little bit, there'll be more opportunity for them at more reasonable prices to find the partners that they want to plug in overall to a vision that they have to grow out their company.
I want to, Todd, play devil's advocate for a second, because people have heard, well, if I roll 30%, 40% or whatever into the next entity, some people say, well, just consider that you're never going to get it.
Right.
So what are your thoughts on, and what have you seen rolling percentage into the next entity?
Yeah. So there's two factors there, right? There's the earnout piece, and then there's a roll forward piece. I can tell you on these trophies over my shoulder, our clients get them all. We spend a lot of time making sure that works. And the buyer wants the earnout and the equity piece to work. Now, the other thing to keep in mind is, and you know this, and anyone that's listened to other episodes, we kind of bifurcate the world in two types of transactions: exit transactions and evolutionary transactions. And the exit being, I'm done. I want to roll out and sell it for as much money as you can because I'm not working anymore. We do a few of those, not a lot of those. Most of ours are evolutionary transactions where our client wants to do bigger and better things. So in the exit transaction, the dynamics are a little bit different. And so with the evolutionary transaction that we do, I'll give you an example. Is a digital marketing firm 2.5 years ago. It was Thanksgiving of 2019. And our client was a real good firm. They were just under 2 million of EBITDA at the end of 2019. That's where they closed. Our clients got single digit millions in cash at close, and they retained almost 40% equity in the company. That one important thing I learned from that changed their risk tolerance dramatically, right? Because they were growing a business and they know how to go A to B to A to B to B to C and so on, growing 15% a year, doing a wonderful job. Once they got that X amount of $1 million, from their perspective, they had already won. And now we're playing with house money. Fast forward, again, we're in the middle of 22. It's 2.5 months later. That business, Jeremy, has a trailing 12-month EBITDA of $15 million. From 2 to 15 in 2.5 years. A business like that probably would trade for, 14 or 15 or 16 times on EBITDA, even in current markets. So that's what, 220, 240, whatever $million. They've got probably $30-ish million of debt from the transactions. And my client's has been reduced to or diluted down to about 25 or 26%. But they own a quarter of a $200 million business, right? Which isn't bad. When I tell that story, and then I look at the other transactions like Demand Drive and CSS and some of these others, their intent, their desire is very similar to that. Very similar to that. Can they execute on that? Certainly a lot easier with a really good partner. And we talked about this just before we came on. If you go back and listen to the interview with Grayson LaFrance from Power Digital, he talks about the transaction he did with Periscope Equity. And 3.5 years later, he had taken his EBITDA from $6 million when he did that first transaction to $30 million of EBITDA in 3 years. And now he's with the people at Court Square, another great private equity group. He's reloaded with cash, and they're looking for execution on the pieces that they want to put together. So when you look at a vision like that, and I would really encourage people to go listen to Grayson's interview. If you look at a vision like that, unlike the politicians that represent us these days, this is a vision that's longer than the next 60 days or quarter or 2 quarters. This is a multi-year vision. And the variance in your multiple of 6 to 7 or 5.5 to 6.5 or 8 to 7.5 is not where you win or lose, right? You do a fair deal, you try to get a good piece of a company for the future that you want to be a part of that fits with your strategy, and you execute against that. That's what we love to do and spend a lot of our time doing.
There's 2 things I want to break down for a second. One is we have to talk about the 2 to 15 million. And the second is, because I think most people visualize an exit being think of it as a true just exit and not a evolutionary transaction where they're leaving. I was talking to another agency owner a couple of weeks ago, and they were saying, "Oh, I don't want to sell my company." But when you frame it as, well, when you're selling your company, you're still doing what you like to do and maybe cutting out the stuff you don't like to do. In a large organization where you have more resources, it's a different conversation, because that person in their mind, I think, was thinking, when I exit, I stop working, which is not the case with how you are explaining this. So I'd love to dig into those, but I want to start with the 2 to 15 million, right? Is that because of resources and acquisitions? How do you explain that?
Yeah, so great question. That deal, remember, was November of 19. So that was 3 months before the start of COVID. Over the summer of COVID, their first acquisition was a $5.5 million EBITDA business. It was almost 3 times their size. A great transaction for both parties, funded by private equity, right? And that was a huge win. Cross-sell capability, sharing of clients, all sorts of stuff. They've done 3 other transactions since then to get them to that 15 million. If you look, again, Grayson will tell the story. You don't grow from 6 to 30 million in 3 years without doing acquisition. Fancy term would be inorganic growth, right? Organic growth is just, building your sales team and doing all those things. Grayson did 4 transactions, right? And they're on the hunt to do a whole bunch more. So acquisition is an important part of every strategy going forward. And when we talk about that, you can look at it really from 2 lenses. Number one, the examples I just gave you, but at the end here, Worth e-commerce. And again, you can go back to Worth e-commerce. Dean was the founder of that business. We did an interview with him, so you can listen to that interview. Dean was below where most private equity firms will do a transaction to have you be the platform company. And I told him that. But I said, listen, here's if we could do this for you, it'd be a home run. If you could be the first or second tuck-in, the first or second acquisition of a company that's backed by private equity, you get virtually all of the upside. In most cases, you get a lot of the same terms as the private equity platform company, and yet you don't have to be the size. That makes a lot more sense for you. So long story short, after some period of time, we spoke to the people at SmartBug, which is a top tier HubSpot partner, really great group, backed by a great private equity group in American Discovery Capital. And they have a plan that we want a HubSpot agency, a Klaviyo, and a Marketo agency. And with that, we can move, that's going to be our go-to-market. I said, geez, I got a Klaviyo guy, and the fit was great. They wanted the exact same thing that Dean wanted, and we were able to put together a really good transaction, and Dean got chips off the table, real cash at close, and he's got a big chunk of equity. He took close to half of the total value of his transaction in equity in the new company. So he's got a significant upside.
From a private equity standpoint, I know there's probably a range, Todd, but what's the range in years? So someone's thinking, well, if I'm the first platform or first tuck in, how many years until they're going to sell and cash out? And then, or I get acquired in, year 3 in their growth strategy of acquisitions. What's the range that private equity?
Yeah, it's a great question. So as a rule, private equity is 4 to 7 years. As an example, Grayson was out in 3. Right? So it's a rule. It's not a hard number. So you figure 4 to 7 years because they're running a business that requires, that they realize capital and move capital around. So let's say it's 4 to 7 years. So if you get in as the first tuck in, you should expect you're going to be part of that organization for the next 5 to 7 years, but you're going to get a lot of the upside. If you're with a group that has been with private equity for 5 or 6 years already, the upside will be much less, but you might be fully cashed out in another year, free to do whatever you want. And you think about that, it would, by comparison, you might get another 50% a year from now. So you sold a business for $4 million in cash and $4 million in stock. A year from now, maybe that stock's worth $6 or $7 million. It's just not going to be worth 12 or 14 or 15.
Yeah. And now on the exit versus the evolutionary transaction, if someone comes to you and they truly are burnt out and they just want to get out, it's typically, would you say it's not as good of a fit?
Oh, no, we do those, and the Man Marketing, Ed Maloff had founded that business 41 years ago. And it's like, I'm done, right? Just get me a good, and there was a thing for him. Ed wanted, like we all do, fair compensation for the company he spent 40 years building. But he said, Todd, these people have been with me 40 years. I need a good home for them. The great thing about small companies, you don't do any financial engineering with small companies, right? You need to grow a small company into a larger small company to really make money from it. So private equity doesn't buy a $2 million EBITDA business and say, geez, if we can get rid of that one controller, we're going to make an extra 60 grand of EBITDA next year, right? Nobody goes into it with that. Typically, particularly today, most buyers need more people to execute their strategy, not less. So it creates a tremendous opportunity for everybody on the team, and that's an attraction. But I will say this, the criteria for a transaction like that is a lot different because it's just one thing, right? Who's going to pay me the most amount of money? And I will say this, every single time we do a transaction like this, the seller says to me, want a fair price, want a really good home for my people. What they don't tell me, but I know is true, I just don't want to spend $1 more for the good place for my employees, right? It's always whoever offers the most amount of money, almost always.
Let's talk about the next part of the year and just in the future in general. What should sellers expect regarding valuation, deal structure, and, because like you said, there's a lot of changes that are going on right now.
Yeah, I think what we'll see, if I were to guess, there's a ripple effect that I explained earlier about what debt is going to require. They're going to require more capital. More capital means lower multiples, and lower multiples mean, lower overall valuation. So I think that's what we'll see, and that doesn't really trouble me all that much. Standard valuations had increased. We had a very robust market. We had a booming economy. We had all of that. Economies don't do that endlessly. Our economy operates in cycles. And so we're going through one cycle into another. There will be lots of transactions that will continue to happen. Maybe you won't get 8x or 7x or 6x for your business, but a good business that's well run will always have opportunities, always. And so depending on your view, if your view is I want to sell, get top dollar and not have to work anymore, then it may be that I would say this, the second half of 22 will not be as attractive as the second half of 21 was. But options are still there for sure.
And I know most of the transactions you do are in the digital transformation, digital marketing space. And do you think things will slow down or increase? And it's funny because we just, came off, we're still experiencing COVID. So do you think COVID compared to increased inflation, did you see it slow down more then or heat up compared to right now?
Yeah, so COVID, now with the vision of hindsight, was a 3-month blip, right? We went from March to roughly June, where people were really scared. Nobody was working. We don't know what this means. And literally we got a V recovery in digital and in digital marketing. And then on top of that, people realized, wow, we should spend all of our marketing money in a place where we can measure it and know what's working and what's not. And that will continue. And so we'll see more and more and more as people get better at providing analytics and data to support the marketing that they do. So that I think will certainly, will certainly continue. And the same thing with digital transformation. We're certainly, in the early innings, I think, as far as digital transformation and all the opportunities that provides. And with companies being more mobile now, work from home, work from anywhere, work from wherever is appropriate, that just creates opportunity for, all the people that we serve.
So that's on the kind of the digital agency side. And then on the private equity side, you mentioned a few things of how it may affect private equity. Like they may need to not pay as much because they're not getting as much from banks potentially. But I guess the other side of the coin is they have a 5-year plan, right? And so it's not like, even though this is happening right now, certain things are happening right now, they still have a plan going out 5 years. Is there anything else that you see impacts private equity right now, positively or negatively?
Yeah, I'll make one comment first and then answer that specifically. I was checking something on LinkedIn and I saw this really short story that I think is a good one. And this guy had this old antique pickup truck that he sold online to a guy. And he said, by happenstance, I ran into the guy a year later. And we talked about it. And he said, listen, I got to tell you, I sold that truck. Because I had asked him, how's the truck? He said, I sold it. I said, oh, did you? He said, yeah, I sold it for 3 times what I paid you for it. And the guy said, I wasn't upset, but I asked him, Jesus, man, how'd you do that? He said, well, I put one of those Texaco stars on the door and gas delivered at any time or some on the side. And we did a couple other things. And I took it to auction. And there were 2 guys at the auction that had to have it. One guy owned a great gas station in Nebraska somewhere, wanted to park it out front. And these guys just kept bidding up. And I think for small companies, you see that. And I've said to buyers oftentimes, if you make a mistake and overpay for my guy, what does it cost you? $1 million long term? You're a $200 million business, you're a $50 million business, you're whatever it might be. And then to your earlier point, if my team is confident about their future and their growth, I can say, listen, the extra $1 million we're haggling over, pay us at the end of next year when we perform in the way that we talked about, right? We know what we're going to do. We're very confident around that. So I think there will be ways over the balance of the year to construct a deal that will preserve the multiple, but maybe with a little bit less cash or a little bit less equity and a little bit more earn out a year later. And while earn out for a lot of people is a negative, for me, I find that it's a way that we can just grasp more from the buyer. When we can say, listen, we think this is the right multiple. And if we perform like this over the first year that you own us, you should be happy to pay out an extra $2 million or $500,000 or whatever the number might be. And that the key to all of that is finding someone that sees a ton of value beyond just multiplying your EBITDA times this multiple to get to that number. And when you can do that in an evolutionary transaction, you can create real value for both our client, the seller, and the buyer.
It sounds like, there's a lot of art and science to structuring the deal.
There is, and having a good buyer and having multiple good buyers is how you get the result, right? Just like the guy taking the truck to the auction. All I need is two guys that are really excited about it. And when you can find that, again, we're not selling the truck, so it's a little bit different, and there's other criteria, but it certainly helps you negotiate either better value or better terms or better things that are important to my client.
Todd, I have one last question. Before I ask it, I want to point people to check out the podcast, go to Second Bite Podcast, check out PotomacBusinessCapital.com. If an agency right now is thinking about selling, what are some things what questions do you typically ask them when you get on the phone with someone when they call you?
My questions are in response to their question, which is always, what's the agency worth? Right? And it is not a simple answer. It's a complicated answer. It's a nuanced answer. But my questions are, EBITDA, of course, what's EBITDA growth? What is your recurring revenue? What is your retention? Hopefully there's not customer concentration in the rest. And then I'll give you an example. We've got a really good buyer now, backed by private equity, that we have a client in front of. Their criteria in their digital marketing, we want agencies that offer one service. And so the one that we happens to be another Klaviyo partner, email marketing and retention marketing. But they know that they can sell the other suite of services to all those clients. And that will allow them to be aggressive on the value. Because we're going to make up a whole bunch more from them and blah, 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 all that kind of stuff, which is an interesting strategy, but one that works really well, right? So from that perspective, from an agency standpoint, understand your weakness. We did a great transaction 2 years ago. My client's customer retention was below average. So number one, I don't want to be caught by surprise and act like that's not true. Right? We said, listen, here's the reason why it's below average. Here's how we fix it. This is why we're looking to do a deal. This is why we think you would be a good partner. But when somebody says, what's your retention? And you say, oh, it's pretty good. That's a really big red flag, right? I want you to answer that in two ways. Number one, it's 88.3%. And then to know if that's good or not, right? Because if the market's 92, then you're a little bit below. I'd like to know why. I'll give you another example. Just this is part of the world of a banker, right? We have one client, his retention is like 70%. When we dug into it a little bit, we found out that there was kind of two cohorts there. There was a group that they can't get to stay more than 4 months because that's their minimum. Their approach to the market is, listen, somebody that stays with us 4 months, they're profitable to us. Some of those will turn into long-term clients, but we do not discriminate. If they want to sign up as a client, we take it because that's what we do at our size. And that's part of our marketing. If you get rid of the 4-month people in that 70% number, it goes to 91%. So get out the 4-month people. Our retention is 91%. When we did that transaction, the buyer's like, geez, we hadn't really thought of it that way. Say, listen, you guys don't want, I understand you want to be more discriminate when you bring on a new customer. I get that. You're also 75 million in revenue. We're 12. This is what we do. When you buy us, after our earnout is done, if you want to operate differently, we have no problem with that. And we did a great transaction with them. So showing that you understand the business well, the challenges of the business and the solutions to those challenges, however difficult they may be, is a great way to present your business. So understand those things. And
I love that.
I'll give you a quick pitch for us. Those things come out when we have a conversation, because we've done this, dozens and dozens of times. We ask what people think are pretty intuitive questions, and we hear a lot of times, "Oh, geez, I never thought about it like that."
Todd, I love it. People should come to you. They should know their EBITDA, their recurring revenue, and their retention, and that will make the conversation go a lot quicker and go a lot deeper.
Yeah. It'll be more meaningful for them for sure.
We have to have another conversation at some point, not on this call, but I'd love to hear your take on maybe an agency that doesn't have a lot of recurring revenue, or maybe just a small portion is recurring revenue, like a website development company. Maybe they have some recurring, but they're one-off projects, right? So
I'll leave you with a little tickler here. Number one, that gets you a lower multiple because there's less certainty to the revenue stream. Number two, we have a client like that right now that we're going to get 3, maybe 4 offers for. They do not have recurring revenue, but they have reoccurring revenue. So what we did is we said, okay, so here's the ABC company, which has been a client for 5 years. Here's how much revenue they did with us each year. None of it's recurring, but we do such great work, they come back to us all the time. There's a story in there to tell. Let's just find out what the good story is and we'll tell it.
Love it. Check out Second Bite Podcast. Check out PotomacBusinessCapital.com. And Todd, thanks for having me.
Jeremy, it's always great being with you. Thank you.
Thanks for listening to the Second Bite Podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.